Welcome to Financial Investing Radio, where you'll learn the secrets for consistent, high-probability returns in the financial markets for additional income to change your life. Grant applies consistent, high-probability trading systems for the financial markets. He's only recently started sharing these tried and true market secrets. As a gift to listeners, Grant is offering his roadmap to high-probability financial control. Go to financialinvestingradio.com and download yours today. Now, here's your host and trading veteran, Grant Larson.
Okay, hey, welcome everybody. This is Grant Larson. Thank you for being on another episode of Financial Investing Radio. I am incredibly excited today because I've got a guest here with me that is someone that I really respect, who's come really through the trenches and has been where all the action has started. And I'm not going to spill any of that because I want to introduce this guest to you. His name is Stephen Sweet. Stephen is a vice president of Zaner Futures Group. He's been a professional trader. He's been a member of the exchange. Wow. And he's also been a trading systems author. Now, Stephen has been kind enough to allow us to have several podcast interviews with him. So very, very grateful to you, Stephen. Thank you and welcome.
Well, thank you, Greg. Pleasure to be here. I'm excited.
Thank you so much. I appreciate that. There's so much that takes place. Now, you're out in the Chicago area, so you're sort of at in the core areas where a lot of the futures, of course, trading takes place, which is huge for this market. I have obviously a whole bunch of questions for you that I want to ask, but a lot of it I want to get started with is around your origin. When did you get started with the markets?
Well, Grant, it was actually kind of accidental. I was, heading more towards an engineering degree in my school days, college days, and I had a good friend of mine that had started right out of high school. He just jumped college and went straight to the trading pits on the LaSalle Street in Chicago. He was on the Midwest Stock Exchange, and he was really excited about it. He was learning the ropes from the ground up and having a great time doing it. And at that time, I really wasn't passionate about the markets. I mean, my focus was another way, as I said, engineering. And he says, you got to come down here and take a look at this. He says, these markets are exploding. They're looking for people to be involved in on the ground levels to help these firms get, bigger and process more, trading action. So I went down there and he toured me around the trading floor and I went down there several times with him and I got a little taste of it. Not so much, from the I got to make money or I can make money at this, but the whole system of how things worked. And then, of course, the opportunities that I saw, for growth personally, in a field like this. And I decided, you know what, I'm going to give this a shot. So I put schooling on hold and I jumped on board with Merrill Lynch. And that was, the mid part of the 70s. So I'm kind of dating myself, but that's how I got started. And basically, it started with floor operations, doing the runner thing, moving around and worked my way up on the CBOE, through several ranks, ladders with Merrill Lynch and, got up into the management levels. I mean, the operations were huge. And at the same time, watching all of this madness going on in the trading pits, it was just incredible. Organized chaos, as someone once said. It's like a beehive in there of activity, runners going in and out, giving brokers orders, brokers shouting at each other here and there all day long. It was a vibe in there that was extremely exciting. So throughout my career going with Merrill Lynch, I spent, all of it conducting, operations and support for the trading floors. And that would be the CBOE, Chicago Board of Options Exchange. Those is where your equity options are traded. Chicago Board of Trade, where the grains are traded and, your treasuries are traded there. And then, on to the Chicago Mercantile Exchange, where they were doing a lot of the meat contracts. And the new kid on top, new kid in the block was the S&P contract, S&P futures. And they added currency futures and a whole host of other things. But again, just being centrally located on these exchanges and watching this go on, I got a stronger taste, about what I wanted to do, what I'd like to do in the markets. And that was to be able to actually be part of that action. But I was fortunate because I was around traders that did this all the time, friends with them, gave them orders, and watched this whole thing right from the sidelines. And so I had kind of an education over those years. And I kind of knew what I was doing, what I wanted to do, and how I was going to do it. And the funny thing is, when I finally got my opportunity to say, all right, I'm going to buy my membership, Merrill Lynch helped me with that. And it was an IOM membership on the Chicago Mercantile Exchange, and where I could trade the index and option futures contracts. That's what IOM, index options market. And it was a separate sub-exchange within the CME. And I went through all the training and everything else to be a broker down there, and got into the trading pits. I said, I'm ready to launch here. And I got in there, we're shoulder to shoulder in these pits with these other guys, and they're like looking at you, what are you doing here? Well, I'm going to give this a shot. Okay, well, this is my ground, that's your ground, and it was a club, if you will. I mean, it was so different on the inside. It was every man for himself, obviously, and a lot of things happened in the pits that people didn't even realize was going on. This bump and grind constantly, and the Monday morning, everybody's sweating and yelling and, everything else going on. It wasn't always terribly chaotic, but again, that kind of vibe was going on. And I was probably about 3 days in, and I go, what the heck am I doing? It was like black and white from the outside looking in, and then getting inside there and saying, now I'm going to, inside the machine, and I'm going to operate inside the machine. And so it was a shock to me that I thought I was all prepared for this, yet I really wasn't. And the part that was the scariest part was the fact that things were moving so fast, and you had to find out what was going on to be able to take your position. We didn't have charts. You're standing in a pit. You don't have a chart. You had an order ticket in front of you that you're filling, a card that you would mark. I bought, so many from so-and-so, or I sold so many to so-and-so. That's all it was. We would step out of the pits every once in a while. We'd have a clerk doing a simple point and figure chart or something like that to kind of give us an idea where the market's been and where it's likely to go. But again, it was all, I don't want to call it seat of the pants, but there was a different way of trading down there. And these guys were making big dollars doing this, and they were risking big dollars as well. And I had to figure out how they felt confident enough to do this. And over the months, I figured out, for myself, what these guys were kind of looking at and where I could take my piece of the action. And a large part of that came from, looking at the big filling brokers. Understand there's 100 people in a pit in some cases. Sometimes there's 50 people, all brokers. Guys that are filling orders, guys that are market making for the exchange, guys like myself that were out there trying to make an independent living, just scalping back and forth, positioning whatever we were going to do. So all those types were in the pit. And I learned myself, and from being, interactive with some of the brokers that I knew down there all those years before I jumped in, is that we needed to follow the vibe, the pressure, what was happening, what was driving these prices. So we knew fundamentally what was going on. We had point figure charts we'd look at. We also had support and resistance numbers that we would take a look at. We'd buy them, for example, very expensive back then, and pivot points and things. I think more people are familiar with that term. And we would use those as potential points of resistance or support. But largely, we would watch the volume levels come into the market on a big order, for example, and no one could see what the other person was doing. It was against the rules. You couldn't share where I got to stop here, I got to this and that. No, you could lose your license. You could lose your membership if you ever did that. So everything was close to the vest. You just had to feel that vibe and find out what was going on and jump on board.
So is there a kind of energy in the room where you could tell some action was taking place and you take note of it? Were those the kind of indicators?
Oh, yeah. I mean, you knew who the big brokers were that were executing orders for the big institutions. And, for some, it's an assumption, but, many cases this guy comes in and, we're not talking guys that come in and buy a one lot for a retail client. Some guys were executing orders, for big institutions, like I said before, and you'd figure they got 50 to 100, maybe 500 to buy. And, they're going to move the market a little bit, because the pressure they're going to put on, their need to buy. The institution may say, we need to buy 500. And we need to buy them now. And, we don't want to be moving the market. So keep yourself, close to the vest. Don't let everybody know what you're doing. It's like poker, So, they would come in. Hey, what's the market right now? And the crowd yell back at them, we're, 40 bid at 45, And, I'm going to buy this, okay, 45 offer for 5. Boom, you're done, They buy them, and they would put pressure on the market where they're repeated entry into the market again. What's the market now? What's the market now? Boom. And the market invariably would be, if it was sold at 45, now it's offered at 50, and they would call back, offered at 50, buy 100. Boom. Market offered at 55 now, buy 100. So he's working in order, getting things done, but trying not to move the market too much. But invariably, he is, because of his pressure coming to the market.
So
basically,
he just starts feeding out these orders a little bit at a time then.
Yeah. And then again, we did not know if he had 50 to buy, or he had 100 to buy, or 200 to buy. And again, we're looking at other technical factors as well. But when you're a scalper down there, newbie like myself, even some of the other guys, well, you know what? I'll buy 50 too. I buy 50, market's up, up another, 2 or 3, 4 ticks now as this guy, drives through the market trying to buy his next 50, his next 100, his next 200, for example. And all we're looking at, hey, we're up, 5 ticks in the currencies at $12.50 a pop, all right, at 50 contracts, sold.
Yeah.
I just sold them to you. So I made in a few minutes, if that, you're out of the contract. Now, it was a risk, and it really was a risk. We didn't know how far he was going to drive this market with this, or if he was going to drive it. So it was a risk. But again, that was one of the pressures, basic, Econ 101, supply and demand. So the demand was high, and the supply was piecemealed out on the way up. So
yeah, interesting. So it's riding the coattails, if you will, of who the big players were.
Yeah. In many cases you were. And then, in some cases there was other factors you'd use, like I said, support and resistance numbers. I happened to be trading the currency options at the time. And one of the things that was going on is back in the late 70s and 80s, I was doing a lot of the Deutschmark trading down there, Swiss francs. I get in that period every once in a while, Japanese yen a little bit, but a lot of it was going on at that time they called it the Deutschmark. The euro currency contract euro currency had not been invented yet, for Europe. But, again, so everything was, Deutschmark versus the US dollar, Swiss franc versus the US dollar, Japanese yen versus the US dollar futures contracts. And one of the things that I had learned from a guy that had schooled me a little bit on currency trading was that the large central banks were constantly into managing proper trade levels, currency exchange rates between the countries, because that promoted or hindered trade between the countries. So the German Bundesbank, which is their version of the Fed, they were in the control in their currency rates to make sure that there was a good balance on the currency exchange rate, so that the Deutschmark didn't become terribly expensive. And if it was terribly expensive, obviously that could it's going to impact trade a little bit, because now all the goods you're buying, you have to pay more U.S. dollars to buy more, buy the equal amount of Deutschmarks. So they were, in the central banks here, the Fed was the same way. So what was interesting is the guy that taught me about currencies was that there is this faction going on between the Bundesbanks to make sure that the trade remains fair and open and constant and at a level. So the Fed would intervene as well, and they would push down the dollar price or rise up the dollar price in accordance. So he had learned, he was a Forex trader for years, and he had learned that there was a central balance of payment level that would be most conducive to trade, and he basically targets. And how he knew this, I did not know, but it was uncanny that when the Deutschmark got to a certain level over the course of sometimes an hour or a couple of days, in comes the Bundesbank, boom, selling Deutschmarks.
Wow.
Or if it got the other way around, boom, in comes the Fed buying U.S. dollars. It was interesting. It was uncanny.
That's fascinating. I mean, identifying those patterns, I'm sure was life and death. And how many different markets did you trade then? So you did currencies. What else did you trade?
I trade a little bit of the S&P, but back then when I was doing it, the S&P was the S&P 500. And that means it was, $500 a point, a little risky for me, but so I had the index and options market seat, which again, I could trade the S&P, the NASDAQ. I eventually got into trading the S&P a little bit down there as a member when they cut it in half. They went to a 250 multiplier, which is where it currently is now. They call it the big contract. The E-mini S&P is 1/5 of that now, which is a $50,000, or a 50 multiplier instead of a 250 multiplier on the big contract. That is $50 per point versus 250.
Amazing. Well, so can you talk about you? So you've walked through this transition in the markets, right? You've been there where you've been right in the action on the pit, but then you notice that world change from the floor trading to electronic trading. Can you talk about that journey and what you've seen come out of that?
Yeah, very difficult. It's like night and day. And people would tell you, well, you're a trader. No, you know what? Something was going on in the pit where you could actually do well. As I said before, you can understand what was going on. But you get out of that, you start looking at charts, which a lot of people that were off on the pits did. And those guys were typically doing longer term trading. They were working with hedging groups, for example, that would have a corn crop, for example, that would be hedged. The scalper could not survive that way. The short-term trader, he didn't have the information that he needed to be able to, do those quick trades. So the people that were, when I got off floor, for example, it's, you start looking at, well, am I going to be a long-term trader now? So I get in the hedging group, learn to read long-term charts and do something like this. And I started saying, well, no, I was never a big fan of it. And it wasn't until years later that I started looking at screen-based trading again, because that's the way most of it was going. I mean, I will tell you that 90% of the traders that left the trading floor in the late 90s because the volume was going away never made it.
Wow.
Screen-based trading.
Wow.
And it was because their culture wasn't there. They couldn't see it. And they were always learning, yearning for their old days. They did this, they took away our license here, they went electronic trading, and, our jobs are gone. Our livelihoods are gone. And they, begrudgingly tried it, but they couldn't get a feeling for that vibe. Me either. I mean, you're looking at a screen versus being in the pit and seeing it all happen. I mean, you can see that it'd be very, very difficult to make the transition.
Yeah.
And at the behest of one of the traders in my office, we started looking, and I said, I'm not a long-term trading guy. I'm not a hedger guy. I mean, I came from this kind of background, and I'd like to be a short-term trader. So he said, start looking at a few indicators, and I still don't get it. I don't know what these indicators are telling me, and I knew what I wanted to see. I knew what I wanted to feel.
Yeah.
I wanted that vibe so I could, understand where I could be in this market the way I understood it when I was in the pits.
So that's interesting that, over the years, you've gone through this transition, you've participated in the electronic trading, but you went through the pain of that. I got to believe with the length of time that you've been involved with the markets, whether it's in the pit or through the electronic trading, that you've seen some patterns of problems that traders deal with regardless of the market. Can you identify what are some of the problems you've observed over this long period of time?
Well, good question, because, loosely, I could say the biggest problem with screen-based trading is it can be used as legalized gambling, if you will, and what I mean by that is that, you punch a button and you're in the market. You punch a button, you're out of the market. And, you're looking at a chart, but what ends up happening is more people, in my opinion, are strictly watching price. They're watching an action in the marketplace. I mean, there's given days in the S&P or crude oil or any of the contracts, currencies, what have you, that prices are moving around like crazy. And you're looking at prices. And again, I think so many people, I think the fault is they're really gambling. And what I mean by that is that they don't have any more information than they would if they were let me just back up. They have information there, but they're not processing any further information more than they would if they're rolling the dice, on the table.
Yeah.
And I don't mean that as that everybody's doing that, but the fact that prices are moving around like that is kind of like, the screaming and the shouting and the laughing and the bells and whistles going off or bells going off in Vegas. It's attractive. You watch this stuff, you go, wow, look at this. I could do this, I could do that. So they're simply watching price and, loosely applying, hey, I'm gonna buy here right now, or I'm gonna buy on a pullback here. I see the market doing this or that. I'm gonna give it a shot. And again, I don't want to mislabel every trader out there as screen bases a gambler. Certainly they're not. They're trying in other ways to actually be, more consistent in doing this, but without knowing what's happening in the marketplace and why it's possibly moving this way or what its tendencies are today, I mean, there's a blind spot, and the price draws you in, the price action draws you in, and you may hit it. You may make 2 or 3 points, for example, and you go, wow, I am pumped up, right? Well, they have no idea that they go back in again with the same plan, and then they go, boom, the market just whacks them hard, and then they hold on to a trade. I was right before, I can be right again, and they hold on, and it gets deep. So the problem, I think, is over trading and loosely trading on loose information. That's what I see.
Yeah, I imagine that's pervasive from what you've seen. That's probably regardless of any market, right? I mean, it doesn't matter what you're trading in. Okay, everyone's got access to this subset of information. So these self-destructive patterns that you've observed, they're, all of us deal with that. We've all gone through it as we do this electronic trading. Have you observed good behaviors over the years, either whether it's through the pit or electronic things? What good things have you recognized or seen that traders are doing?
Well, I do notice, and again, I don't closely monitor every single client account out there, but we'll take a look, and what I see is good, and I think this has to be with all traders, is they take a break from it. The good traders will take a break from it. They'll they'll have sometimes a day or two away, and you don't know what they're doing, but they'll have some break time, which kind of leads me to believing that they're, I mean, it could be a lot of things, but, maybe they're reassessing at the time, and looking at markets. And some days, quite frankly, Grant, there really isn't really much to do. If you're sizing things up, you will find that it's not necessarily a good day to be trading. Fed's going to be speaking, what have you. That somebody sits on the sidelines, or big economic news comes out, that they sit on the sidelines for a little bit and wait for that information to filter through the market before they jump in. That's good behavior, in my opinion. Again, I can't validate that the people that are taking breaks are actually doing that, but those are the types of things that I think I have, seen, that it gives people a better opportunity to breathe a little bit and not get so excited by all the, the bells and whistles going off with market action.
Gotcha. So you sit in this very unique situation in two ways. One, your longevity in the markets, both from the pit to electronic trading. That's one. The other is your position of seeing and working with lots of clients, lots of traders, as a brokerage, right? As a vice president in Zaner's. You see these patterns of behavior. I got to believe it's put you in a position to identify these bad patterns as well as good patterns, and to do something about that. Now, I'm not going to talk about what that is, because we're going to move on to some of that into the next episode. But I got to believe that you're in a unique position to do something about that.
Yeah, I mean, we get, I have myself, I have quite a few accounts, and I keep a good open dialogue with them as well. When they want to. The traders that are doing it on the level we're talking about are doing it on their own independently. They don't want to be bothered. They don't want to be led around. But I do have a few quite a few clients that will call up every once in a while, and we'll talk about struggles and what have you that they're having. And again, I think there is a way to develop maybe into the trader that they want to be. And it's a personal thing. I learned that, as I said earlier, that there's such a small percentage of people that can actually do this, consistently. And I think that has a lot to do with your personal makeup, your plans and goals for yourself, and how you feel about risk, because it's all about risk. And one of the things that I've always felt, and from day one when I was just a newbie into the pits, is risk. I mean, hey, there is risk. There's upside on this thing. You can see it, all the bells and whistles going on, but there's risk. And if you can't respect and manage that properly, you're going to be a flash in the pan. You can make $1,000 one day and lose $2,000 the next. Without a plan. So I mean, it takes some work, and I've had conversations with people before about what's the answer, and there is no simple answer. There's no book out there you can read, no course that you can go to that for 3 or 4 days, no matter if you spend $20,000 on it, that's gonna instantly transform you into that trader that you want to be. It's a growth period that you have to go through, and you really have to understand yourself and the markets, what's going on, to be able to be consistently successful. And I don't mean that you make money on every single trade, but you manage risk properly so that you're taking lesser risk, if you will. You can mitigate. You can't completely get rid of it. You can mitigate it with certain steps and understandings, but you can't get rid of it. So that part, which I've always said, that's the part you need to get a handle on first.
Yeah.
The risk side of it. Because it's going to make you more comfortable when you're in the market.
Yeah, having that good, strong understanding of risk, and does it make sense to you also that you have a good understanding of yourself? Because I tend to think that trading actually requires you to know yourself, because you're actually trading yourself. You really are the market, and your perceptions of it and everything that turns out to be the reality, whether or not it's correct. But you have to know yourself well also. Is that have you observed that as well?
100%. Absolutely. We're all individuals, and can anybody be a trader? Good possibility they can, but not just, there's a certain makeup, I think, that some people are born with as risk takers. Other people can develop it and understand a little bit. Me with an engineering type background, at least I'm starting in that, very detailed, and all the details matter to me. I have to see the big picture. I have to see where this is actually what it's supposed to be, and how do we get there? So for me, that's kind of my makeup inside, and that was developed by my studies, and and that's where I lead it to. And I think that if you can get this to a mechanical level, and understand yourself a little bit, I think making it mechanical, that is understanding how you can manage the risk and how you can cite opportunities, what have you, leads us to a more comfortable position when we decide to get in the market. We're never going to be 100%, comfortably, because there's risk there.
Yeah.
But you could be, more confident, in what you have, by understanding exactly what your plan is, what I plan to do. I'm not going to get, willy-nilly here and run seat of the pants here. It's just crazy. So to make some sense out of this this organized chaos out there was a mission, and whether you'll fully understand every bit of it, maybe not ever, but you can understand your part of it. That's all, and how you could actually manage it. And so, I think a trader can be developed, but again, a lot of it, as you had mentioned, it's personal makeup. You have to get that other part under control, the emotion side of it, because if it rears its head, the emotion, whether that's, positive or negative, it's going to impact everything we do.
Well, Stephen, you have been so gracious with your time here today. I appreciate you taking us through your journey and identifying, the challenges that you've seen. We look forward to our next interview with Stephen because he's going to start to unfold what he and the other executives at the Zaner Futures Group have done to help traders address these issues. Very exciting. Stephen, thanks again for joining. I really appreciate that. And everybody, get control of that risk, as Stephen pointed out, and know yourself and what your capabilities are. Thanks again for joining, and until next time, trade safe.
Thank you for joining Grant on Financial Investing Radio. Remember to subscribe and leave feedback. Don't forget to download your free roadmap to high probability financial control before you make an investment decision. Visit financialinvestingradio.com now.